In this world, nothing can be said to be certain, except death and taxes. Benjamin Franklin. A robust third-quarter GDP report may discourage the Federal Reserve from lowering interest rates, but it has little impact on the upcoming November FOMC meeting, as Lindsay Rosner of Goldman Sachs Asset Management explains.
Join our YouTube community. Be part of our YouTube journey. Subscribe now. Get exclusive content, stay updated, and join a community of like-minded enthusiasts. Please subscribe for $1,000 early bird draw.
Rosner's view is that the Fed is more likely to maintain current interest rates, higher and hold, rather than raising them, higher and hiking. Market expectations suggest a 99% likelihood that the Fed will keep interest rates steady at 25% minus 5% during its October 31 November 1 meeting, while the chance of a 25 basis point rate hike in December is at 20%. Rosner believes that future GDP growth may slow down, as certain factors contributing to the strong third-quarter GDP are unlikely to recur. She emphasizes that they will closely monitor developments in private domestic demand, such as consumption and investment, rather than solely focusing on headline GDP figures. U.S. technology stocks, particularly the Nasdaq 100, are facing downward pressure, with a potential entry into correction territory after a 10.3% decline from a July closing high. The Nasdaq Composite is officially in correction territory, having fallen more than 10% from its high close in July. Initial jobless claims increased by 10,000 to 210,000 in the week ended October 21, slightly higher than the Wall Street Journal's economist estimates. The number of people already collecting jobless benefits in the week ended October 14 rose by 63,000 to 1.79 million, indicating potential difficulties in finding new employment. Despite rising jobless claims, overall employment conditions remain strong, and economic growth may not slow in the fourth quarter, which could necessitate further rate hikes by the Fed. The increase in continued claims raises concerns about a potential softening in labor demand, with some workers unable to secure new jobs quickly. Following the release of this data, stock markets were set to open lower, while the 10-year Treasury yield fell to 5%. In September, U.S. pending home sales increased by 1.1% compared to the previous month, as reported by the National Association of Realtors, NAR. However, these numbers were still near record lows, primarily due to the challenges posed by high mortgage rates and a shortage of available homes. Pending home sales, which indicate signed contracts for existing home sales not yet closed, were down by 11% when compared to the previous year. This data suggests ongoing struggles in the real estate market. The NAR also released its forecast for existing home sales in 2023, projecting a substantial decline of 17.5%, which would bring sales to their slowest pace since 2008. This decline is attributed to the persistently low inventory of homes. Despite this, the NAR expects the median home price to increase by 0.1% in 2023 to reach $386,700. The organization foresees a rebound in home sales in 2024, with a projected increase of 13.5%, and a slight rise in home prices by 0.7% to $389,500. Additionally, the NAR anticipates a decline in 30-year mortgage rates, from the current high levels, to 7% in 2023 and 6% in 2024. The U.S. housing market is currently facing challenges on both the demand and supply sides, with high mortgage rates discouraging buyers and low inventory driving up home prices. Despite these hurdles, the NAR expresses confidence that the housing sector will recover in the coming year, emphasizing the need for increased inventory to stimulate overall market activity. A recent bond market meltdown has raised concerns on Wall Street as Treasury prices have sharply declined, causing benchmark 10-year yields to surpass 5% for the first time in 16 years. To understand this market turmoil, it's important to know that bonds represent loans made by investors to governments and companies, and bond yields are the interest rate returns on these investments. When yields rise, bond prices fall, which is what has been happening recently. The bond market upheaval is being driven by two main factors: the Federal Reserve's significant interest rate hikes over the past 18 months and the escalating U.S. government debt. The Fed's actions have made fixed returns on bonds less attractive to investors, leading to declining bond prices. Additionally, the U.S. government's mounting debt, which has tripled over the last 2 decades, is causing concerns as it threatens to flood the market with an excess supply of bonds and bills, outstripping demand. This bond market turmoil has implications for various aspects of the economy. Higher bond yields can impact stocks, with investors seeking the higher relative returns in bonds over equities. Rising yields also lead to increased interest rates on mortgages, loans, and credit card bills, affecting ordinary Americans. Furthermore, it can make it more expensive for companies to borrow, potentially leading to cost-cutting measures, including layoffs. As such, the bond market's performance is gaining more attention due to its potential consequences for the broader economy and people's finances. The Federal Reserve's decision to maintain steady interest rates is aimed at controlling inflation while avoiding a recession, but it comes with risks. Higher U.S. interest rates could draw attention to the government's growing borrowing and debt service, potentially creating political pressures. Furthermore, the slow approach to curbing inflation may lead to elevated inflation expectations, limiting the Fed's flexibility in addressing other issues in the financial sector. U.S. GDP growth is expected to slow, with the resumption of student loan payments set to reduce consumer spending by $100 billion. The excess savings accumulated during the COVID-19 pandemic are dwindling, and while recession fears have eased, inflation remains well above the Fed's 2% target. Federal Reserve Chair Jerome Powell's stance suggests that patience may allow monetary policy to address inflation effectively. However, rising inflation expectations and potential limitations on the Fed's ability to stabilize banks are emerging challenges. In this environment, investors are less responsive to rising interest rates due to expectations of persistent high inflation. Commercial real estate and the debt of lesser-rated companies face challenges, which may persist if inflation expectations are not addressed promptly. In the face of economic challenges, individuals can bolster their financial resilience by creating or revising financial plans, building emergency funds, managing debts wisely, and diversifying income sources. Businesses can navigate economic uncertainties by improving financial management, diversifying products or services, embracing digital transformation, and forming strategic partnerships. Cost control, employee training, supply chain resilience, market research, and financial counseling are additional measures that contribute to adaptability and sustainability in an ever-changing economic landscape.
Buying good stocks can be a good investment for several reasons. 1. Potential for capital appreciation. 2. Dividend income. 3. Diversification. 4. Liquidity. 5. Ownership and voting rights. 6. Historical returns. 7. Inflation hedge. 8. Professional management. 9. Tax benefits. 10. Accessibility. It's important to note that while investing in good stocks can offer significant advantages, it also carries risks. Stock prices can be volatile, and there is no guarantee of positive returns. To make informed investment decisions, it's essential to conduct thorough research, consider your financial goals and risk tolerance, and, if necessary, seek advice from financial professionals.